There's a moment in every market cycle when something small, ignored, or ridiculed suddenly turns into the focal point of the financial world. And when that moment arrives, most people swear they saw it coming, even though they spent years laughing at it. I don't think we've reached that moment for XRP yet, but I believe we are getting dangerously close to a tipping point. And the most intriguing part isn't the price, the lawsuit drama, or even the technology. It's the behavior happening behind closed doors, where the most meaningful decisions never get tweeted, posted, or hyped. What concerns me is not what people are celebrating. What concerns me is what they are not being told. The loudest narratives in markets are usually distractions. The real leverage in finance tends to be silent. When I look at XRP, what I see is a system that appears tightly managed, purposefully restrained, and strangely coordinated. I'm not talking about price manipulation in the way amateur analysts try to explain every red candle. I'm talking about influence, control, the invisible pressure that molds a future market before it exists. If XRP truly represents a new standard for cross-border financial settlement, then its value isn't only speculative. Its value is systemic, and systemic assets do not move freely. They are shaped, they are guided, they are prepared. Let's start with something most investors ignore: liquidity corridors. They sound boring, but they reveal everything. Traditional crypto traders obsess over candles, volume spikes, and trend lines. They overlook the fact that cross-border payment solutions require something fundamentally different from speculative markets. They require predetermined liquidity rails where value flows through institutional channels like plumbing. Speculation wants price excitement. Settlement requires stability. The more XRP matures into a settlement asset, the more its price movement will look artificial, capped, and oddly consistent. That's the first sign of control. XRP isn't being allowed to behave like a retail investment asset. It's being shaped into infrastructure. This raises a question that few dare to ask out loud. If a digital asset is meant to operate like infrastructure, who owns the controls? Who decides supply access, distribution timing, liquidity availability, and regulatory compliance? Does a decentralized asset remain decentralized if its utility depends on centralized institutions? Investors debate decentralization like it's a philosophical topic. Banks treat decentralization like a useful myth. They adopt systems that provide efficiency without giving up leverage. A decentralized settlement network is good. A decentralized monetary system is not. Institutions want the technology, not the revolution. That's why I believe XRP's biggest influence is not happening at exchanges, in retail trading, or in public narratives. It's happening in private corridors between regulatory bodies, banking networks, fintech service providers, and liquidity provisioning firms. If the public markets seem slow, dull, or unpredictable, it's because we're watching the wrong layer of the system. Retail traders see candles. Institutions see pipelines. And pipelines don't form based on excitement. They form based on strategy. XRP is being positioned, not promoted. One thing that reinforces this idea is the stark contrast between what happens publicly and what happens quietly. Publicly, the debate still revolves around lawsuits, legal clarity, volatility, skepticism, mockery, and occasional hype cycles. Privately, corridors expand, institutional partnerships strengthen, and digital asset custody regulations mature. If markets truly operated based on public sentiment, XRP would be a volatile, unstable, unadopted token. Instead, it is quietly becoming part of a structured network that behaves nothing like crypto and everything like legacy finance infrastructure. That kind of transformation doesn't happen organically. It happens intentionally, but control, especially in financial systems, is never absolute. It's always selective. The goal isn't to suppress price forever. It's to moderate price until a system is ready. Think about historical commodities. Before railroads scaled, coal was cheap and unstable. Before global oil trading matured, petroleum markets were fragmented, unregulated, and volatile. Once infrastructure was established, prices became strategically managed by supply decisions, political influence, and trade agreements. Control wasn't about manipulation. It was about stability, serving geopolitical priority. If XRP represents a settlement commodity rather than a speculative token, then its price behavior will evolve similar to commodities that support infrastructure. It will be shaped for utility, then priced for scarcity. But the shaping comes first. This is why early investors are confused. They expect the market structure of a speculative asset, but are holding something transitioning into a settlement commodity. They expect volatility to reflect sentiment. They expect adoption news to produce breakouts. They expect regulatory wins to trigger rallies. They are applying the rules of speculation to a system in the process of becoming infrastructure. And infrastructure assets don't respond to headlines. They respond to deployment. The idea that XRP is being intentionally controlled to function as financial infrastructure rather than a speculative asset is uncomfortable for many retail investors because it contradicts almost everything they expect from a digital asset. Most people enter crypto markets assuming they are participating in a decentralized, free-moving, unpredictable environment driven by public sentiment. They expect the market to reward excitement and punish uncertainty. But the more I've studied XRP's evolution, the more it becomes clear that the forces shaping it are not emotional, not chaotic, and not reactive. They are methodical, strategic, and calculated. These are signs of a system being engineered, not a token being traded. XRP is being molded into a settlement instrument, and settlement instruments are not allowed to behave like gambling chips. They must behave like infrastructure. Market participants often confuse decentralization with absence of oversight. They believe that if a project is decentralized, it should evolve organically, driven by community interest and demand. That may work for experimental networks or assets with no institutional purpose. But the moment a digital asset is tied to cross-border payments, banks, regulatory frameworks, compliance structures, and liquidity provisioning, the architecture surrounding it cannot be left to chance. For XRP to be usable by institutions, its price cannot fluctuate wildly just because a handful of traders panic or a celebrity tweet creates hysteria. Institutions need predictability. They need cost stability. They need a settlement mechanism that behaves more like a commodity and less like a meme stock. If XRP were allowed to move purely on speculative behavior today, it would destabilize its future purpose. So the market doesn't let it. When I analyze traditional infrastructure assets, this pattern repeats. Before oil became a strategic commodity, its pricing was chaotic, unstable, and dictated by scattered producers. Once transportation, warfare, and industrial growth made oil indispensable, governments and corporations began controlling its flow and pricing. The same happened with railroads, steel, telecommunications bandwidth, and electricity. Anything that becomes foundational to economic systems eventually transitions from speculation to strategic management. The speculation phase ends the moment a commodity becomes necessary. XRP is moving into that phase. What looks like suppression is actually refinement. The most obvious sign of controlled behavior is the lack of correlation between XRP's adoption progress and its price movement. Most crypto assets respond with sharp spikes when major partnerships are announced. XRP doesn't. Most assets decline sharply after legal pressure. XRP stabilizes. Speculative markets mirror emotion. Strategic markets mirror intention. If a market does not behave emotionally, it means the emotional participants are not the ones in control. Something more structured is guiding the outcome. That doesn't mean someone is pulling levers in a dark room. It means the asset's future role demands a different kind of market governance. A digital token that could potentially touch international money transfers cannot evolve like a hobbyist experiment. There is also the matter of supply distribution. XRP's allocation pattern resembles logistics planning, not retail speculation. Instead of being widely scattered across speculative traders, supply repeatedly finds its way into institutional channels, custody arrangements, and liquidity provisioning systems. That's not normal behavior for a typical altcoin. It's normal behavior for a resource preparing for utility. Retail traders mistake supply allocation for bearish selling pressure, but allocations to institutions are not dilution. They are deployment. A settlement system cannot run without distributed liquidity. You cannot power a global network with scarcity. You must first distribute enough fuel to activate corridors. Scarcity only becomes valuable once the system is functioning. This is why calling XRP suppressed misses the point. It's not being suppressed. It's being held in a preparatory range. Price movement is being moderated because the network is not ready to use scarcity as a value driver. The market is not punishing investors. It's conditioning an asset. A speculative narrative would destroy that preparation. Crypto traders think they are waiting for a breakout. What they are actually waiting for is a transition. And that transition will redefine XRP from a speculative asset to a financial instrument that behaves nothing like the assets they are used to trading. When that shift is complete, the controlled behavior seen today will make sense in hindsight. The price didn't stagnate because it was weak. It stagnated because it was being engineered for stability, so it could eventually be priced for necessity. The idea that current price suppression is strategic rather than manipulative challenges the core emotional expectations of retail investors. Most people see a low or stagnant price and assume something or someone is preventing them from earning wealth they believe they deserve for being early. They interpret silence as deception and stability as weakness. But if a digital asset is intended to function as the plumbing of a global financial network, then price stability is not only expected, it is required. You cannot build a settlement system on an unstable, speculative commodity whose value swings based on sentiment and social media noise. For a token to take on a utility role within the infrastructure of global finance, it must remain predictable, affordable, and liquid during its build-out phase, even if investors wish for the opposite. Retail traders tend to measure success through immediate price appreciation. Institutions measure success through usability. An asset being prepared for large-scale infrastructure must first be cheap enough to be used by payment providers, banks, and liquidity operators without destroying their cost models. Volatility may excite traders, but it destroys the viability of settlement. Imagine a remittance provider using a digital asset to send billions of dollars every week. If the cost of that asset fluctuates wildly, then every transaction becomes a risk rather than a dependable function. The system cannot scale if the tool it uses becomes more expensive the moment demand increases. Retail investors cheer for price spikes. Institutions see them as operational hazards. This is why suppression, if we call it that, is not sabotage, it is stabilization. The price of XRP needs to remain within a controlled range so that corridors can form, liquidity can spread, and usage can expand. Infrastructure cannot be built on a rapidly rising asset. Price suppression is not someone holding back value. It is the market locking in a functional cost structure. Think about commodities like copper or lumber. During infrastructure growth phases, governments and corporations take steps to prevent sudden inflation because rising costs hinder construction. The commodity becomes more valuable for what it enables, not for what it makes speculators rich immediately. Those who mistake utility preparation for lack of progress simply don't understand this phase of development. It also makes sense that liquidity remains abundant rather than constrained. Retail investors believe scarcity should matter now, but if XRP became scarce while the infrastructure is still being built, it would become unusable. A tool that is too expensive cannot be scaled. If a technology depends on a resource, that resource must first be plentiful and predictable. The time to make it scarce comes only after deployment. Strategic resources are often underpriced during preparation and repriced only after their function is established. Oil didn't skyrocket in value before the industrial world used it. Its price soared only after it became indispensable. Assets that are destined to support infrastructure are intentionally kept affordable until they are necessary, not until they are hyped. The market behavior surrounding XRP resembles this pattern. Every time demand appears ready to create scarcity, supply becomes available. That isn't random selling, it's provisioning. Retail traders interpret supply increases as dilution. In reality, it is distribution. Infrastructure needs fuel. A global settlement system must have access to liquidity everywhere it is used. If XRP were allowed to rise too early, it would become a bottleneck instead of a solution. The network would be crippled by cost. And so retail investors grow frustrated because they believe they are being held hostage. In reality, they are witnessing a phase where their expectations conflict with the requirements of engineering. Early speculators want price action. Global institutions want reliability. Only one of those objectives matters for long-term value. Value built on speculation elapses the moment sentiment shifts. Value built on dependency becomes unavoidable. The price doesn't need to rise now. It needs to become necessary. Strategic suppression protects its future purpose, even if it disappoints impatient investors. The market isn't ignoring XRP's potential. It's protecting it from premature inflation. Price will matter only when utility demands scarcity. Until then, stability is not manipulation. It is preparation. The idea that retail holders are acting as passive liquidity providers for banks and institutions is one of the most uncomfortable truths in this market. Most investors believe they are early adopters, visionary participants, and future beneficiaries of an asset that will eventually reward their patience. But in the current phase of XRP's development, the greater value they provide is not as beneficiaries but as reservoirs of liquidity. Without realizing it, they are helping build the very infrastructure they hope will make them wealthy. They are holding a resource that institutions do not yet want to compete for, but eventually will need to acquire. Until that shift occurs, retail investors serve a function that benefits the system more than it benefits them. Liquidity is a fundamental requirement for any payment network. Without enough circulating supply in the market, no settlement system can operate efficiently. For a digital asset to support global transactions, it must be widely distributed, easily accessible, and available on demand for whoever needs it. If the asset were held too tightly by institutions prematurely, there would be no fluid marketplace, no pricing transparency, no natural distribution, and no decentralized liquidity. Retail investors solve this problem unintentionally. By holding XRP as a long-term speculative asset, they create a dispersed liquidity base. Their emotional patience, often driven by hope of large future gains, allows institutions to slowly build corridors and infrastructure without facing scarcity. In traditional finance, liquidity providers are paid to deploy capital so markets can function. Retail holders, however, are not being paid. They are volunteering their capital through belief and expectation. In their minds, they are securing future profit by being early. But in practice, they are supplying liquidity in the same way banks do in the early stages of a new market structure, only without compensation. This is not evidence of exploitation. It is evidence of timing. The market does not need to reward liquidity providers early. It needs them to facilitate network development. Their future compensation is implied in the eventual institutional demand that will materialize only after the system reaches maturity. The distribution of XRP is often misunderstood because retail traders see increasing circulating supply as dilution or dumping. They assume someone is cashing out at their expense, but the reality is more strategic. Liquidity must be seeded into exchanges, custodial platforms, and corridor-ready institutions. It must be accessible across jurisdictions, markets, and time zones. If too few entities hold too much supply, the network cannot operate smoothly. Retail accumulation makes the asset fluid, not stagnant. While traders obsess over price, the system uses their holdings to enable deployment. What makes this dynamic interesting is that retail investors believe they are in control because they hold supply. But control while the market is passive is not real control. When institutions eventually need XRP at scale, they will not politely negotiate with retail holders. They will not announce their intentions on social media or wait for buy signals. They will accumulate aggressively and quietly, the same way they accumulate any scarce commodity once a system depends on it. Until that point, retail holders feel special for being early. When the system reaches velocity, Their real value emerges not from having held XRP, but from having held it long enough for institutions to need it. This is why patience without understanding is dangerous. Investors who think they are just waiting for a price breakout are not seeing their role clearly. They are acting as functional parts of a system they do not yet comprehend. They will only benefit if they can hold beyond the moment when the network shifts from build-out to demand-driven scarcity. Those who expect early reward will likely exit before the market requires their supply. They will supply liquidity long enough to build the infrastructure, but will sell before scarcity matters. In doing so, they will prepare the market, but not benefit from it. Retail holders are not being deceived. They simply misunderstand their timing. They are the liquidity layer that enables institutions to organize the system. Their value is not in being early. It is in lasting long enough to matter when the system finally needs what they are holding. Only then does patience become profit rather than participation. The belief that XRP's true value will not appear until settlement volume reaches maturity is uncomfortable because it shifts the reward timeline away from speculation and into structural necessity. Most investors want value today. They expect a digital asset with strong partnerships, real-world usage potential, and regulatory discussions to respond immediately with a growing price. But financial infrastructure does not reward potential. It rewards dependency. Until a system is used at scale, its components remain undervalued because their importance has not yet been realized in real-world demand. For XRP, this means its price is not waiting for hype, it is waiting for velocity. A token designed to serve international payments cannot be fully valued until the system relying on it is active enough to require constant liquidity. Market participants often misunderstand the nature of adoption. They believe the announcement of a partnership is the same as utilization. They assume the moment an entity explores or tests a settlement solution, demand instantly increases. But adoption does not function like social trends. It does not grow with attention, it grows with necessity. A bank might test XRP's rails for years before fully deploying it. That testing does not create meaningful demand. It does not trigger price appreciation because the system is not yet reliant on the asset to function. The value of a utility asset emerges only after dependency exists. Until that point, everything is research, preparation, and infrastructure construction. Investors are not misled, they are simply premature in their expectations. Scarcity becomes a value driver only when supply is insufficient for demand. If there is little demand, scarcity is meaningless. This is why price movement is minimal today. The network does not need scarce XRP while it is still being prepared. Once the network matures and daily settlement volumes depend on XRP, the equation changes structurally. The price no longer reflects expectations. It reflects operational risk. If liquidity becomes too expensive or too scarce, institutions must either tolerate higher costs or accumulate XRP aggressively to protect their business models. In that scenario, rising price is not speculation, it is self-defense. A market that must function cannot allow its fuel to run out. This pattern mirrors historical commodity behavior. Before global shipping demand surged, steel was ordinary. Before massive electrification, copper was cheap. Before industrialization, oil was nearly worthless. These materials had potential, long before they had dependency. Their real value emerged not when people realized they were useful, but when the world could not operate without them. XRP's value lives in the same principle. The moment institutions cannot run their settlement models without it, price becomes a reflection of necessity, not narrative. Utility does not create hype, it creates pressure, and pressure forces repricing. Retail investors believe a breakout will be gradual, triggered by excitement, media coverage, and new waves of speculation. But a structural repricing event is rarely slow or predictable. It does not resemble a typical bull market. When necessity overtakes supply, markets reprice aggressively because they are correcting misvaluation rather than chasing exaggeration. It will feel sudden because it will not be driven by trader expectations. It will be driven by institutional need. The market is not preparing for a speculative spike, it is preparing for a liquidity shift. This difference matters. Speculative spikes collapse because they are built on emotion. Structural repricing sustains because it is built on operational obligation. Most retail investors will not recognize the transition when it begins because they are waiting for the old signals, breakouts, technical patterns, influencer predictions, media hype. But the real trigger will be volume, infrastructure completion, and matured settlement flows. Utility does not announce itself. It simply becomes too important to ignore. And at that moment, the price will no longer reflect hope. It will reflect dependency. The investors who understand this will not overestimate time or panic during quiet phases. They will wait not for hype, but for the moment when the world quietly becomes unable to function without what they already hold. Only then does XRP stop behaving like a speculative asset and start behaving like a necessary one. It is very easy to assume that when something important is happening in financial markets, it will be loud, obvious, and full of headlines. Investors expect a storm to roar, not to whisper. Yet the most powerful shifts in financial systems have a strange habit of taking place quietly, beneath the surface, where only a few people bother to look. This is exactly the reason why people misunderstand the rise of XRP. They expect a dramatic explosion, a public celebration, a sweeping narrative that makes everyone nod in agreement. But that is not how global finance works, especially not when governments and institutions are involved. What most investors don't realize is that XRP's story is not about hype or public sentiment. It is about the silent accumulation of control in places that operate away from the spotlight. The pattern is familiar. Whenever something is poised to have an outsized impact on financial infrastructure, it is never allowed to be purely open. Control follows value, and value is never left unmanaged. When observing XRP, the market focuses on price movements, exchanges, and public lawsuits. But very few look at the flow of partnerships, the quiet accumulation of regulatory bridges, and the way global banking infrastructure is being rewired one agreement at a time. The public sees a cryptocurrency with a fluctuating market price. The institutions see a settlement mechanism, a liquidity bridge, and a programmable asset that can be controlled through policy rather than speculation. That difference alone creates an imbalance in understanding. Speculators assume the price reflects everything, yet historically the underlying technology or resource becomes valuable long before the public realizes how deeply it is integrated. Investors didn't see the railroad value until tracks were already laid. They didn't see the oil industry's dominance until companies controlled pipelines and refineries. They didn't see the rise of credit until banks already controlled debt. In each case, the asset became important first, and the price followed later. Control came before recognition, and recognition arrived only when the average person no longer had access to the first mover advantage. So when I talk about institutional accumulation not being about price, I mean exactly that. The institutions that matter do not chase candles, tweets, or charts. They accumulate time, position, and influence. With XRP, the question is not how high the price can go, but who wants control over the infrastructure that determines its issuance, usage, and legal positioning. The biggest misconception in crypto is the belief that decentralization protects value. In reality, value attracts centralization, whether the community likes it or not. And the more strategically useful XRP becomes, the more regulated, tested, and quietly positioned it will be. This is why the public never sees the real shift happening. They are looking at markets, while the real decisions are made at regulatory tables and private compliance agreements and through governmental partnerships that most investors don't read or even understand. Value is created in the public markets, but control is established in paperwork. There is a misconception that price movement equals progress. But institutional involvement doesn't create parabolic growth instantly. It creates a framework that ensures market dominance later. The public wants volatility, institutions want predictability, the average trader wants speed, governments want structure. Therefore, if XRP is becoming foundational to future global liquidity and settlements, the last thing regulators want is chaos. They want it bottlenecked, organized, and restrained until the system is ready for widespread adoption. This is why the price hasn't reflected the scale of the network being built. It's like looking at a dam while it's still under construction and expecting to see a flood. The water pressure is building, but until the gates are opened, the flow will look insignificant. Personally, I find that realization far more compelling than any chart pattern, because it means the price doesn't matter yet. What matters is what the asset is being prepared to do. Investors get distracted by the visible, but the real game is always played behind the scenes. The most misleading assumption people make about new financial systems is that they will emerge through visible innovation, loud announcements, and public disruption. It sounds reasonable to believe that if something is going to change the global economy, it will do so in a way that everyone can clearly observe. But history contradicts that belief. The largest transformations in money did not occur through public excitement. They occurred through slow integration into existing power structures. Gold did not become a global standard because the public campaigned for it. Fiat currencies did not take over because citizens demanded paper money. Central banks did not gain influence because investors voted for it. In each case, the shift happened because existing authorities recognized a tool they could utilize, shape, regulate, and ultimately control. What matters in financial evolution is not the speed of adoption, but the degree of control established before the adoption takes place. This is the overlooked reality behind XRP's trajectory. It is not waiting to explode publicly, it is being prepared structurally. Most investors are still looking at XRP as if it were a volatile digital investment fighting for market dominance against other cryptocurrencies. They assume that success will come from hype, mainstream excitement, or sudden speculative growth. This is an outdated view based on how early crypto markets behaved. But XRP is not competing to be the next viral token. It is competing, or rather being positioned, to become part of the monetary plumbing that the average user never notices directly. Railroads transformed trade routes, but the public didn't invest in the tracks. They only used the trains once the infrastructure was already in place. Credit cards changed consumer spending, but users never saw the networks and agreements behind the transaction terminals. There was no marketing campaign that explained the death of cash. It simply faded as financial systems quietly digitized payments over time. When something becomes infrastructure, it stops being a product. It becomes a utility, controlled by policy, not popularity. The idea that XRP will be a decentralized revolution where individuals gain power is incompatible with how governments handle monetary systems. If something becomes essential to economic flow, it will not remain outside regulatory reach. Governments don't surrender control over banking rails. They don't outsource liquidity bridges without strict oversight. Even stablecoins are being cornered through regulation because they interfere with the monopoly over issuance, settlement, and cross-border flow. If XRP was destined to remain purely decentralized, it would not be receiving institutional attention at all. Institutions do not integrate systems they cannot influence. They do not rely on assets they cannot legally regulate. They do not allow key financial mechanisms to remain in a chaotic, permissionless environment. So, if XRP is being tested, scrutinized, and slowly threaded into international frameworks, it is not for the purpose of empowering retail investors. It is for the purpose of strengthening controlled liquidity networks. This truth is uncomfortable for many crypto enthusiasts because it contradicts the narrative that decentralization will liberate markets. But decentralization has never threatened power structures. It has merely pushed them to adapt and absorb new tools. The most valuable assets always end up regulated because the absence of regulation threatens their scalability. Without centralized oversight, no government would allow their financial institutions to rely on a system that could operate outside legal control. XRP's real future, therefore, lies not in rebellion, but in assimilation. It will not overthrow the system, it will become part of it. And that raises a single important question: when something becomes infrastructure, who benefits the most? It is never the early believers who hoped for freedom. It is the entities that regulate the flow, decide the rules, and gain the power to expand or restrict usage. XRP's potential is not a promise of decentralization, it is a negotiation for dominance. And that is why the real opportunity is not in dreaming about decentralized liberation, but in recognizing how value moves when control is being consolidated. If XRP succeeds, it will be because it was allowed to succeed under specific terms, not because it escaped regulation. The investors who understand this are not cheering for explosive growth tomorrow. They are watching how the regulatory landscape is shaping the role XRP will be permitted to play. They focus less on immediate price action and more on the slow alignment of legal frameworks, settlement systems, and compliance mechanisms. Those who cling to the idea of crypto as a rebellion will miss the true inflection point because they are looking for a revolution instead of a merger. The future of XRP is not chaos, it is structure. And structure always benefits those who build it, not those who merely observe it.